Before we talk markets, we need to define what this bill actually is in plain language. The Clarity Act is a market structure framework designed to end the legal gray zone in U.S. crypto regulation. For years, investors have been forced to price two layers of risk at once: normal market risk and policy risk created by unclear jurisdiction and inconsistent enforcement pathways. The Act tries to shrink that second layer. Its core function is to clarify which assets and activities sit under SEC treatment and which belong under CFTC treatment, especially when a network reaches maturity and decentralization thresholds. In practice, that means classification rules become more explicit. Which tokens are treated as investment contract securities in current state? Which tokens can transition into digital commodity treatment once objective criteria are met? And which intermediaries are subject to which registration, disclosure, and conduct obligations? For exchanges and intermediaries, this creates a clearer compliance map around onboarding standards, conflict controls, customer asset protections, and market integrity supervision. For token teams, this changes planning cycles. Instead of guessing what might trigger a future enforcement theory, teams can design around more predictable legal lanes. For investors, this changes valuation assumptions. When legal treatment has a more knowable framework, discount rates tied to regulatory uncertainty can normalize. That does not mean all risk disappears. It means the risk gets more measurable. Also important, this is not a full stablecoin law by itself, and it is not tax reform. This is market structure architecture. Think of it as plumbing, rails, and jurisdiction boundaries that determine how Bitcoin, exchanges, and altcoin ecosystems are governed in the U.S. Now, the exact hurdle it just cleared and why this step matters. The Clarity Act advanced out of the Senate Banking Committee in a 15-9 vote. That is a formal procedural milestone, not a symbolic headline, because committee advancement is required before the bill can move to full Senate floor action. The committee process included amendment pressure around investor protections, anti-money laundering concerns, ethics language, and the boundary between centralized and decentralized activity. So this was not a simple roll call in an empty room. This was a contested gate where negotiation changed floor viability. The vote included bipartisan support, which matters because floor passage mechanics are sensitive to coalition width once cloture math comes into play. In other words, this step did not deliver law, but it did preserve a realistic pathway to law. The clean interpretation is momentum improved, process risk remains, and every next vote now carries higher market relevance. Committee movement opens the next legal gate. It does not close the process. Here is the concrete path from committee progress to federal law, step by step, with no shortcuts. Step 1. Senate leadership has to schedule floor consideration. Without calendar time, a bill can sit in procedural limbo, no matter how strong the committee signal looked. Step 2. Floor debate and cloture mechanics come into focus. To limit debate and avoid a filibuster block, the bill generally needs cloture support at the 60-vote threshold when all seats are filled. This is often the hardest political gate because it tests whether committee bipartisanship scales to full chamber coalition. Step 3. After cloture clears, the Senate proceeds through amendment handling and final passage mechanics. Final Senate passage itself is majority-based, but only after the procedural gate is unlocked. Step 4. Text alignment. If the Senate version differs from the House-passed version, both chambers must reconcile to identical language through conference, committee, or amendment exchange. Step 5. Both chambers must then pass that same reconciled text. A near miss here can send the bill back into another negotiation loop. Step 6. The enrolled bill goes to the president for signature or veto. If vetoed, override requires 2/3 in both chambers, which is a materially higher political bar. Step 7. Even after signature, implementation is not instantaneous. Relevant agencies still need to translate statutory language into enforceable rules, supervision standards, and compliance timelines. So there is no single magic vote here. This is a mandatory chain of approvals, and every link has to hold for the bill to become operational law. Now the market lens. Price action around policy is usually a repricing story, not a sentiment story. When legal ambiguity compresses, the first effect is often discount rate adjustment in the most liquid assets and highest confidence venues. For Bitcoin, the impact is less about direct classification risk and more about system confidence, institutional access durability, and reduced policy headline volatility. For exchanges, the channel is more direct. A clearer regime can improve listing policy confidence, reduce legal overhang assumptions in business planning, and support longer horizon capital allocation decisions. For altcoins, this likely remains selective, not universal. Projects with stronger disclosure culture, cleaner governance design, and better compliance readiness may capture more upside than the speculative long tail. Market participants should also separate timing from direction. Committee progress can shift probabilities quickly, but full passage risk still introduces event volatility across each gate in the approval chain. Scenario logic helps discipline positioning. If the bill passes mostly intact, the regulatory normalization narrative strengthens, and risk premium can continue compressing. If major amendments alter economic incentives, the market may price partial clarity with delayed transmission into valuations. If progress stalls, uncertainty premium can widen again, and flow can rotate defensively toward Bitcoin dominance and high liquidity instruments. So the key is to treat policy updates as probability shifts across scenarios, not single outcome certainty. Now the portfolio lens, and this is where discipline matters most. Portfolio response should be process-driven, not headline-driven. A practical structure is 3 buckets: core exposure, tactical risk, and a tightly sized high beta sleeve. Core exposure is where long horizon conviction sits, and where position management should not react to every short cycle procedural update. Tactical risk is the adaptive layer. This is where sizing decisions respond to objective legislative triggers, including floor scheduling confidence, cloture whip signals, amendment direction, and House Senate reconciliation quality. The high beta sleeve should stay small, rules-based, and linked to explicit invalidation levels if legal momentum weakens. In practice, that means predefining what would make you reduce risk before volatility forces a rush decision. For example, deterioration in cloture probability, breakdown in reconciliation alignment, or material amendment drift that changes expected economics for specific subsectors. If Senate path signals strengthen, risk can be layered in gradually rather than all at once. If the path deteriorates, priority shifts to capital preservation and waiting for confirmation over prediction. This framework keeps decisions tied to verifiable milestones instead of emotion and social media velocity. One more practical note: keep your information loop consistent. Policy-driven markets punish stale context. Educational content only, not financial advice. For deeper daily macro and crypto context, I publish free daily intelligence briefs and premium research via Gumroad.